Imagine millions of gallons of water building behind a concrete dam. On the surface, the water is calm, but underneath, the pressure is constantly rising until the structure finally gives way and the water bursts through. This chart shows how markets behave when that same type of pressure builds. After a period of flat, sideways price action, the market suddenly shatters the boundary and moves into a new vertical trend. This moment is called a breakout. Identifying this trade entry allows you to capture the initial momentum of a new trend. However, moving before the market confirms that direction often leads to being trapped in a reversal. To trade this safely, we need a plan. We are going to build a complete trade strategy from a raw chart, calculating the exact entry, the critical stop loss, and profit target numbers. Open your charting software so you can follow along. High-probability trading relies on objective signals rather than speculation. It requires waiting for the specific data points that show a market has committed to a new direction. Step 1 is to identify consolidation. Scan your charts for a stock that has stopped its upward or downward movement and is now trading within a narrow sideways range. This diagram outlines a range-bound market. The price is held in place by two specific boundaries, a ceiling called resistance and a floor called support. On a real chart, it looks like this. Notice the blue rectangular box drawn around these clusters of red and blue candlesticks. The market is coiling up right inside that boundary. Step 2 is to mark your resistance. Look at the upper red shaded zone on this chart. You draw a horizontal line across the peaks where the price repeatedly fails to push higher. For this trade, let's set our resistance at 110 rupees. During step 2, your primary objective is restraint. Do not buy as long as the price remains below that 110 rupee threshold. Patience during this phase is your best tool for managing risk. The longer a stock remains between these boundaries, the more significant the eventual move is likely to be. Step 3 is the confirmation. Your entry signal only triggers when a green candle breaks through the black resistance line and closes decisively above 110 rupees. Watch for a false breakout or a fake out. This happens when price briefly peaks above the line but quickly loses momentum and falls back. To filter out these false moves, you need to check the volume. At the bottom of your screen, look for a significant spike in market participation that aligns perfectly with the breakout candle. A price break by itself signals intent. When that break is accompanied by a spike in volume, it represents a concentration of capital actively supporting the move. Step 4 is building the trade plan using our hypothetical parameters, a stock bouncing between 100 and 110 rupees. First, calculate the entry price. Your order should trigger slightly above the confirmed breakout level, at 111 or 112 rupees. Next, set the stop loss to protect your capital. Placing it at 108 rupees ensures you exit if the price fails to hold. To calculate the profit target, measure the height of the consolidation range. 110 minus 100 gives a 10 rupee difference. You add that 10 rupee height to your breakout level. 110 plus 10 establishes a clear profit target at 120 rupees. By calculating your exit points before placing the order, you establish a neutral framework for the trade. Having these numbers in place ahead of time reduces the pressure to make emotional decisions while the trade is active. This process turns a chaotic price chart into a disciplined, risk-managed blueprint for your trade. Now, put this into practice. Open your charting software and identify 3 different stocks currently in a consolidation phase, and map out the boundaries for each. Executing this strategy requires the discipline to ignore intraday fluctuations and wait for a confirmed breakout. Always commit this one rule to memory. The longer the market sleeps, the bigger the move when it wakes up. Professional breakout trading involves letting the market provide a clear signal before committing capital. Wait for the move to declare itself, then execute based on the plan you've already built.